Let's assume for the moment that the Fed funds futures are correct, and there's a 100% chance the Fed will cut rates tomorrow by at least 1/4 of a point to 4 and 4.25%. We've talked a lot about which stocks and sectors stand to benefit from a Fed easing, but which could stumble. Today, Barron's put a fine point on one name in particular, and it may surprise you. In an article entitled, "Berkshire Hathaway Could See a Big Hit If the Fed Slashes Rates, Here's How Much," Barron's says because Warren Buffett's Berkshire Hathaway parks a huge amount of its cash in short-term T-bills, if the Fed goes on a rate-cutting cycle through the end of next year, Berkshire could take a $3 billion hit to the annual interest income he normally gets from those T-bills. Right now, let's take a look at the 3-month and the 6-month. You've got the 3-month just below 4% at 3.973%. But guess what? It was closer to 4%, 4.5% just about 6 months ago, a year ago. Yield on the 6-year, 3.82%. If those rates were to drop, companies that park money in safer government debt, could they take a hit? Well, with the Fed decision less than 24 hours away, let's get right to the floor show. Our floor show guest has $370 billion in assets under management. He's Northwestern Mutual Wealth Management Chief Investment Officer Brent Schutte. Brent, let's talk about sectors, stocks, areas that could perhaps take a bruising if the Fed cuts rates, because we know that small caps will do probably well if the Fed cuts rates because they borrow more. And who knows, what about the other side of this?
Sure. There are certainly companies that are going to be harmed by this because they do make interest income. And so certainly that is the easy math to do. But I think what the article lacked and what other things lack is that there are other parts of the company that may be doing better because the economy may be doing better. And so if you think about banks, for example, they obviously earn net interest income, which could be harmed, but they're much more diversified. And there are other parts of the banking segment or the company that may do better. And so I think it's a bit nuanced. Even higher income consumers, for example, think about those who have actually earned interest on savings accounts the last few years, which is kind of a novel concept that we're back to. But those are going to go lower. I think the more interesting part is what you mentioned before, which I think it ties into our positioning. Think about the parts of the economy that have been harmed by higher rates and have pushed capital towards the parts of the market that are not harmed by higher rates. And so you think about the AI trade, you think about the 10 stocks versus small and mid caps and the broader S&P 500. One of the biggest trades that we believe is going to occur in the next few years is there will be a broadening of the economy as rates come down, or just the economy does better on the back of different policy, which will broaden out the market. And that's where I encourage people to continue to think outside of those 10 names, to continue to think outside of just large cap US stocks and look for those areas of the market that haven't done well the past couple of years because they have been harmed by higher rates. They're hopefully now coming lower.
So you see a little bit of an elevated risk in the huge cap. I think I just made that up. It's large cap, but mega large cap, massive huge cap stocks, but also high yield fixed income. There you're kind of staying away from those areas?
Look, I think I listened to your opening and I had the pleasure of all the things that you went through, and you're talking about an economy that is shifting in many different ways, not a right or a wrong, but a different policy than what we've had. Think about tariffs. We haven't been where we're going to since 1935. And so we'll get from point A to point B. I guess the question is there a hiccup in between, and where is the market and what is it priced for? And that's where I think, the odds of a potential hiccup. We've talked about the labor market. You just had Dennis Lockhart talking about the labor market. There's still the potential for a hiccup, and stocks are pretty much fully priced. And so I want people to be careful to what the risks they're taking. And that's where I would prefer people to still hang out in higher quality fixed income rather than going down the credit spectrum, where right now those spreads are pretty tight based upon people's belief that there is no disruption in the future, which I don't think anyone can guarantee.
Brent, it's good to see you. Thank you very much.